Markets have begun to crash as expected. Without the stimulation and generosity of QE4 from the Fed, the markets can't rise. As it fails, mainstream media propaganda attempt to point fingers in any direction to assist the local markets and buy time until other countries reciprocate. The question is, if nothing was fixed since 2008 and policies have only gotten worse, debt has expanded, and the other end of the spectrum, politicians ignoring what we're about to face, and the general public distracted by their cell phones and TV. All the while, we've had these violent market fluctuations. Who or what is controlling these markets? You came here for the truth, so let me unveil that for you. Today, our topic is the financial crisis, part 2, kicking into high gear. Let's begin with this. You probably have seen it. The market storm that has engulfed Wall Street to start 2016 again took aim at stock investors, with the Dow closing down nearly 400 points on Friday, as increasingly jittery traders reacted to the latest swoon in oil prices and other big sell-off in Chinese stocks. This is what I've been covering since 2016 had started, even before 2016 had started, trying to explain how this would all play out, at least in the short term. The massive sell-off extended the U.S. market's worst start to a year ever to 10 trading sessions. The slide is gaining steam amid raising investors' fears of slowing global growth and even steeper losses in markets. Why did it take the beginning of 2016 for this to start? This is the way it works. But it's a little bit silly to read this kind of information now, knowing all of these problems existed at the end of 2015, but now it's a problem. Well, that's just the way this works. It's one algorithm after another. Don't want to give away too much for my hypothesis right here. Let's continue on to this. Out of the Wall Street Journal, worries about slowing economic growth here, global growth, have plagued stocks for months. But many analysts have maintained that the U.S. economy is relatively healthy and that recent declines in the stock market should stabilize. That's right. Here we have a little bit of propaganda for you and a little bit of comedic relief. It's great to hear this kind of humor that the Wall Street Journal can put out. Very important to have a good laugh once in a while. And although they didn't really suggest it was sarcastic, I'm going to take it as that. U.S. economic data released Friday, however, raised doubts about the economy's strength. U.S. retail sales fell last month, showing consumers are dialing back spending. And then it goes on. I don't know what spending they're talking about other than the increase in Obamacare. See, if you took that out of the equation, you'd have a very different set of numbers. Right at the bottom, or just above that, public pension plans and mutual funds are safeguarding their portfolios by holding more cash than they have in years. The cash is good temporarily, and as an individual, perhaps having some cash is good. But do you want to keep all your money in cash? I don't think so. Because what happens when you really need to make an income from that? Perhaps you lose your job. Well, you have that cash, that's great. But if you're holding it in Swiss francs, for example, do you want to then convert it? Is it going to be worth what you want? Or do you want to make income from your savings? Of course, the way that the hedge funds and the investors and everything, they deal with things a little bit differently, and they're simply out for corporate profits. If this doesn't go for the hedge funds, but if the investment companies, JP Morgan, just as an example, make a big mistake and they lose a lot of money, they don't have to worry because you and I will bail them out. While we expected to have more volatility in 2016, I certainly did not expect the year to start off with this big of a downdraft, and that is Edward Jones. What did they expect? Did they really expect it to do okay? What exactly would make the markets rise at this point? If you said QE4 was coming, then we have an argument. Absolutely, the stock market will rise based on that. But at this point, they're not discussing that at all. They're worried about interest rates for the foreseeable future. Let's move on to this. We have a long video ahead if I don't speed it up. The 2016 market slump has been broader than many previous ones, including even the early stages of the 2008 meltdown. You could see the facts for yourself. Look at the S&P down 8%, the Dow Jones 8.2%. And you will notice here that they are all roughly in sync with each other. They all decline at the same time. Things move together these days, and this is more pronounced today more than ever. Prior to the year 2000, this was actually not the case. You had cycles. So for example, let's say the Japanese stock market would go down. The US stock market or the European stock markets or other Asian stock markets don't necessarily follow the same pattern. Today, though, since 2000, we have had one chasing the other. So a lot of the economic fundamentals have definitely changed over the years as I've been following them. The crash of 1987. The stock market had its single biggest drop in history in October 1987 by 22% in a single day. This is from my book and basically covering the 80s here in this chapter. This was caused by many factors, but essentially the market was leveraged at such a high level, one little gust of wind took it down. What was it? What really happened here? Well, their fancy risk models designed by the PhDs all got to a certain point and they began selling frantically. So that's the way this works. In this case, these are sort of primitive based on what they have now these days. But you have these technology defined by these, let's call them intellectuals, and they simply create formulas that don't really mean anything. And sometimes you have excellent profits. As long as the market's rising, then the market continues to rise. But if it declines, then it continues to decline. Let's move on to this here as you look at USA today. The stock market rout is starting to get really expensive, destroying $2.3 trillion from the top of last year, $1.5 trillion in net wealth just this year. What we're looking at here is basically what we've been waiting for quite some time. I don't look at this as what's happening in 2016, exclusively. This has been waiting and we've been needing this. You need to have a correction. You can't have a stock market that rises forever. It's overdue for a recession. So at the very least, if this isn't the big collapse, then at least there should be some sort of recession. Nevertheless, the solace offered by Wall Street is that another 2008 style deflation and depression is impossible because banks are now better capitalized. However, banks may find that they are less capitalized than regulators now believe because much of their assets are in treasury debt and consumer loans that should be significantly underwater in the next recession brings unprecedented fiscal strain to both the public and the private sectors. So I like the fact that CNBC is actually willing to admit some level of truth. This is an excellent article right here that, if you want to read one of these articles, as always, links are in the description. This is the one, and it's entitled "A Recession Worse Than 2008 is Coming." Most importantly, even if one were to concede financial institutions are less leveraged, the startling truth is that business, the federal government, and the Fed have taken on a humongous amount of additional debt since 2007. So household debt back to its 2007 record. Business debt from 10 trillion, 12 trillion now. National debt from 9 trillion to 18.9 trillion. Fed's balance sheet from 880 billion to 4.5 trillion. 880 billion, which is interesting. Once it was at that point, it had never been, obviously, at that point ever. And there was more debt that was created to that point than all of history, all before it. So it was an extremely high number. and then it was multiplied significantly ever since then. And it's not going to stop. Of course, it will not ever stop. The new market age is decidedly different. Rather than a seething cacophony, aggressive corrections like the current one are directed by a faceless metronome or computer-generated orders, triggering irresistible momentum and trillions in losses. Wow, what have I been saying for the longest time? It's like a broken record. The Money GPS, I'm going to rename the channel to the Broken Record GPS. How many times have I mentioned to you that the computer algorithms are what controls the markets? This is not a conspiracy theory. This is what has been defined. This is how the businesses work. Amid it all, market veterans are left to ponder when the script will flip and the market direction will turn, not by newfound optimism among traders in the pits, but rather by algorithms that generate buy rather than sell signals. Further along in the bottom, it basically talks about how it seems like these programs are all on a sell basis right now. And he gets more specific. It happens first thing in the morning, and then it starts to pick up and this and that. You can read it for yourself. But essentially what they're talking about in this article, another article out of CNBC, is no different than what I've been saying. The whole stock market, the commodities markets, and every other market interconnected, they are all controlled by computer algorithms. It doesn't mean that investors are not investing at all. It just means that truly they are insignificant. If you and your rich neighbors and a whole bunch of people start getting in and invest $1 million into the stocks, those stocks will not move based on your $1 million. If you think, wow, $1 million, that's a lot of money, or let's even say $1 billion, you're not able to move the market anymore. If this was a few years ago, that might have been a possibility. Today, after the financial crisis, the market doesn't move without the plunge protection team holding it up, supporting it on the bottom, and then you have the QE pushing it upwards. If it comes down, you have the computer algorithms to come in there and pick up the pieces. You have the computer algorithms there to push it up to begin with. They can control and sort of manipulate where it goes. It doesn't have probably full control of the system, but it can definitely push it in any which way they desire. This is what I've been talking about for quite some time. The markets are in a sell pattern at this moment. What happens tomorrow, we'll have to see, but there's nothing good about what we've been seeing at this time. They have too much debt, as I've just discussed, and it's only going to get worse. If you found this video informative, please give me a thumbs up. It really helps me out a lot. I truly appreciate that. Last but not least, if you found the video informative, I know you'll find my book, The Money GPS, even more informative. If you want to head over to Amazon, they have a look inside feature. It allows you to flip through the pages of the book and see if you like it. Take care.